everybody, and good evening, and a very warm welcome to one and all the participants. And on behalf of IPNet West Region, I would like to extend my warm welcome to all of you on today's webinar titled as Interactive Session hosted on 3 discussion papers issued by IBBI. And we are truly honored to have our distinguished speakers for the session. Jalesh Grover sir, CA Jalesh Grover sir, CMA Harshad Deshpande sir, and CA Udaraj Patwardhan sir. As you are all aware, IPNet is hosting its 61st webinar in a series of webinars organized periodically under the umbrella of IPNet, the National Network for Insolvency Professional. Now, without any further ado, it is my pleasure to invite Mr. Udayraj Patwardhan sir, member of the National Executive Committee and Regional Head of IPNet West, to deliver a formal welcome address. Sir, the stage is all yours.
Thank you, Gauri. So after our IPNet conclave at Delhi, I couldn't just come back for a couple of Saturdays to have any interaction with you all friends. So today we are having an interesting discussion. Basically, we want to discuss 3 important discussion papers. One is about empowering directors and partners in IPE. This is a very critical topic in which IBBI has given a guidance that there has to be minimum capital and how to empower the directors, partners who are IPs in an IPE. So there is a discussion paper on which we want to have an overview and take your inputs on that. And that will be led, the discussion will be led by Mr. Jalesh Grover. The second one is also very critical, that is the strengthening the valuation processes under IPC. Mr. Harshad Deshpande is a very experienced insolvency professional, a cost accountant, a valuer also, and also an officiating member of the IVO of ICMA also. So he has gotten wide experience on both sides, the operational side as well as on the administrative side. And the last paper of enhancing safeguard and transparency are some improvements that are being suggested by IPBI, so that we will be trying to take up through discussion. What structure that we have is these papers will be discussed and presented by the respective speakers. And whatever comments that we want to convey to IBBI, you may kindly type it out in the chat box and also discuss with us all here, so that at the end of our effort, we will be able to tabulate them, bring it together, and then we will share that with IBBI on behalf of IPNet group as such. So we will be conveying everything to IBBI in an appropriate way, so that those discussions papers are considered by IBBI at appropriate stage before the discussions paper get converted into a regulation. So that is the fundamental idea here. So that with that background, now I request Varshita to play our video. Shortly stating the purpose, initiative, contribution, etc. So, Varshita, please play the IPNet video.
IPNet, India's professional network for insolvency excellence. Because every insolvency professional deserves a voice, a community, and a platform to grow. Building a united, progressive community of insolvency professionals, driving excellence across India. Every week, every topic, every insight, together. Led regionally, united nationally, ensuring every voice is heard. Together, we shape the future of the insolvency profession. Your personalized space for learning, networking, and growth, free for every member. Be part of the mission. Be part of the revolution. Be part of IPNet.
Thank you, Varshita. Gauri, we may proceed now.
We are truly honored to have our distinguished speakers for this session. First topic is empowering director or partner in IPE. So I request Mr. Jalesh Grover to give the presentation.
Thank you. Jaleshji, before we proceed, I will be introducing you.
Okay.
Of course, most of the people know you formally, but a formal introduction is Mr. Jalesh Grover is a finance and legal professional with a robust blend of qualifications as a chartered accountant, MBA finance, registered insolvency professional, a certified forensic auditor, offering end-to-end expertise in corporate finance, insolvency resolution, forensic investigation, and business restructuring. With a career spanning advisory, compliance, resolution, he specializes in navigating complex financial distress situations under the Insolvency and Bankruptcy Code, also conducting forensic audits to uncover any financial irregularities and enabling creditors and stakeholders to recover value through legally sound, commercial, and viable strategies. His strength lies in connecting legal frameworks with financial realities, offering practical data-backed insights to assist lenders and corporates, legal teams, resolution applicants, etc. He is known to be a very skillful person, having expertised in bankruptcy law, personal bankruptcy, and also on the legal side. So he works on the both side of insolvency. Welcome you, sir. I would just display the paper on the screen and then you may take it forward.
Yeah.
I hope it's visible to all.
Yes, sir. It is visible. Yeah. So good evening, everyone. Thank you, IPNet. It's always a pleasure to be aligned with you. So today's topic is discussion paper on empowering director partner in an IPE by proposing minimum shareholding oblique capital contribution. So basically an IPE works two types. One, it provides support services to insolvency professionals, its own partners, directors, or others also. And second, it undertakes also insolvency professional activities themselves, like an individual IP does. So as of now, the regulatory framework is like that the control of IPE remains with IPs by prescribing that majority of the partners or directors of the entity be registered insolvency professionals. So that is the regulatory framework as of now. The statutory provisions are governed by Regulation 12 of the IP Regulations 2016, which provides for the recognition of an insolvency professional entity. So under sub-regulation 1, a company, registered partnership firm, or a limited liability partnership may be recognized as IPE if it fulfills certain conditions, like the majority of the partners or directors of the entity are registered insolvency professional. Sir, please forward next page. So this is the first condition, that the majority of the partners or directors of the entity are registered insolvency professionals. Second condition is that none of the partners or directors of such entity should be a partner or director of another IP. That means there should not be any cross membership. And minimum net worth of the entity is 1 crore of rupees. So there is no net criteria of any partner director as of now, that how much capital contribution a partner or director is required to get out. So as per IBB, that is the statement of problem presently. That at present the ownership, what they say, that at present the ownership and governance structure of IP is very widely in the absence of any participations regarding the minimum capital contribution or shareholding required to be held by each partner or director. So what they say, that thereby it is creating an imbalance in terms of fairness, equity, and accountability in the entity. So, in the absence of specific regulatory guidance, IPs have adopted divergent ownership and capital structure. Of course, since there is no such requirement, so every IPE is following the ways as per their convenience only. But IBA feels that it is leading to non-uniform practices across the ecosystem. The composition has become disproportionate or concentrated, giving rise to governance and fairness concerns. So why concentrated? But IBA feels, which they have the data also, I will explain on the next page, that they say that the majority of the, sir, let it be here only for a while. So what they say that majority of the capital contribution is with few partners, directors of the IPs, and remaining have very negligible thing. So the issues which IPA have identified that they have covered up is the concentration of ownership and control. So basically, the investor partner or a few IPs they hold or contribute significantly larger proportion of equity or capital, and according to them, that is why they are exercising disproportionate control over the management and decision making of the IPE. And this undermines the principles of equitable participation in terms of ownership structure and individual accountability amongst the professional partners. So nominal participation by some IPs, that is the next issue has been identified by the IPs. That certain IPs hold only a symbolic or nominal stake in the IPE, despite bearing equivalent professional responsibility and regulatory accountability. So the analysis which has been done by the IBBI, they have identified 10 IPs having the 233 members of these IPEs. 181, that is 77%, are holding less than 5% stake in the entity. And further, these IPs are holding 85, these IPEs are holding 85 assignments in the capacity of an IP, and 29 of these assignments are being handled by members having less than 5% shareholding capital contribution. It is also observed that the members having less than 5% shareholding capital contribution account for a substantial 70.5% of all individual assignments as IRP, RP, and liquidators. So, in other words, members holding 95% or more shareholding capital contribution IP are holding around 30% of the assignment in individual capacity. So that is why they say that this amounts to a significant imbalance in the workload of an IP as IP and in the individual capacity. And that also underscored the critical role in driving operational success. And the minimum ownership dilutes alignment with the IPE's long-term interest and decision making. So next is lack of uniformity and transparency. So what IPA says that in the absence of a defined threshold limit for the director partner, it has led to variability in ownership models across IPEs, making it difficult to ensure consistency in governance and accountability. So next is they say that professional independency and confidentiality, that as is required that an IP must maintain complete independence and act with objectivity and impartiality throughout the assignment. And because of this reason, because of the reason that they are not having a sufficient capital base with them, so they are unable to display professional independence and confidentiality. And that is why, since this being an essential element, the IBI feels that there should be a minimum capital contribution by all the IPs of the relevant IPE. So what they are proposing, so existing conditions will remain as it is. What I have said earlier, as per Regulation 12 of IP's regulation, that at any point of time, a minimum threshold capital contribution is required to be held by each director or partner, and that minimum is of 5% of paid up equity share capital of a company or the capital contribution of the LLP, as the case may be, provided if an insolvency professional entity has more than 20 members. the minimum prescribed shareholding or the capital contribution of members, as the case may be, shall be reduced on a pro rata basis. So 5% is the minimum. If there are more than 20 members, so that means it will be less than 5%, but it will be pro rata basis on that. So the rationale given by the IBBI is that since IPs are fiduciary and public interest professional and trusted with responsibilities that directly affects all the creditors and stakeholders and integrity of the process, and that is why this is the requirement. And this institutional form through which insolvency professional operates, such as an IPEs, must embody the principles of professional independence, equitable governance, and accountability. So that is the logic behind the IBBI, that since IPs are required to display all such traits, so they should be having a minimum net worth criteria also, all the IPs. So promote fair participation, accountability, and balanced ownership across IPEs. That is why it is proposed that a minimum threshold capital contribution is required from each director or partner of an IPE. So this will, I may say that this will balance the ownership in the organization, and it will also ensure that IPEs remain inclusive and professionally oriented. So the prescription of standardized financial participation norms across IPEs would enable the IBBI to better monitor IPs from a governance on and compliance perspective. So the concern of the IB is clear that if the IPs are not holding sufficient capital contribution, they won't be able to ensure the governance in the IPE, and the members having majority of the stake in IPE, they may be influencing the decision of the IPE, and the IPs having lesser stake in the IPs may not be able to show the independence, and they are might be being regulated by the members who are having majority equity participation in the IPE. That is what IBBI feels, and that is why they have prescribed that there should be a minimum contribution, and so that the every member should have a say in the decision making of the IPE. So that is a concern of the IBA. So of course, but I feel that already the regulation states that IPE and the IPE both are jointly and severally liable for all the acts and omissions of its partners or directors as committed during such partnership or directorship purposes. So IPE is already liable for any act or omission by the concerned IP who has omitted or who has done any act or omission. But so there is no such requirement, there is no such say by the concerned IP in the IP's decision, and due to that reason, IBB has proposed this. Of course, IBA has now asked for comments on this discussion paper. So this is a discussion paper only as of now. So IBA has opened this discussion paper for suggestions by the members, by the stakeholders. And we also invite your suggestions on this, because this is a very small requirement and very small suggestion only. This is not a big paper or big document. People have already started discussions on different platforms on the WhatsApp groups. So I invite the members to give your suggestions and let us have some interaction on the same.
So I can see a couple of members have put the questions on the chat, which is very much welcome. We will be documenting it. But I welcome all, starting with Shantanu have one point. Mr. Pradeep Singh has another point. So, sir, you may come out and discuss openly so that people will be able to interact also. So you are welcome to speak and discuss also.
Should I start?
Yeah.
Sure.
Go ahead.
Namaste all. So my thing was, I think, okay, what they are saying as a problem statement is probably they are not saying it very clearly and diplomatically. They are well reasoned that yes, the IP holding structure is skewed. That was always the case. There were few professionals who had the capital and who could start this 1 crore, putting up this 1 crore, or a few professionals who did that, and then they took in other partners with nominal, stakeholding. Now, my point is, if they are wanting to say that each person must have 5% shareholding, and let's say beyond a point, the IPE may not be able to, increase the number of partners, because let's say 20 people, 5% each, fair enough. Now you have 21st, 22nd, 23rd, and so, and you will have to proportionately reduce your capital contribution or your shareholding. Now, there could be many professionals, working professionals, ex-bankers and all that, who also after retirement want to join an IP as a partner. They may not be able to contribute 5% immediately to the IP's capital. I'm assuming here that each IP is only having 1 crore capital. Now, one is, either they should have said that no single IP insolvency professional by himself should, in my listing, have more than 10% stakeholding or 10% voting share. Something the way it works in the banks. RBI, you may have a certain share in the bank, but your voting right in decision making is restricted to, say, X percentage. That would be probably a better option in my view. Secondly, then if you are going to pro rata reduce the reduce the shareholding of a IPE when more members join, what happens is, then ultimately, if there is a large IPE, this 5% will get diluted to something like 2%, 1%, 3%. So उसमें फिर that whole concept of having skin in the game will go off in my this thing. या तो आप ये करो कि every other guy who comes in needs to contribute an equivalent amount and the capital goes up. If that is the intention, the capital of the IPE goes up. Or you restrict that किसी एक बंदे के पास 10% से ऊपर स्टेक नहीं होना चाहिए, या तो 10% के ऊपर वोटिंग पावर नहीं होना चाहिए.
But actually, sir, in case of a smaller IPE where there are 3 or 4 partners, then 10% will not hold good, sir. Then someone has to have more share.
That's true, sir. जैसे अगर आपके पास 4 ही पार्टनर है, तब तो आप 25% हैं आपके पास, मतलब मिनिमम, if going by this logic, है ना? अब आप अगर हाँ, so they need to probably have a provision कि अगर किसी IPE के पास सिर्फ 4 ही पार्टनर हो, तब क्या? And they don't want to expand beyond 4%. Now they are in a way making it mandatory that all IPs must willy-nilly have 20 partners.
No, sir, what they are saying that every partner should have minimum 5%, and say this is a 4-member company, then 3 of them will have 5% and the remaining one will have 85%.
So that is okay with... that way the problem is not solved anyway.
Yes. That again is an issue which as of now there is no solution as of now presently.
So maybe well intended, but not very clearly conceptualized.
Their only intent is where there are more IPs, there are more than 10, 15, 20 IPs are there, and they're not holding a substantial share.
Yeah.
This is the intent in introducing this provision, I think.
And presently, sir, it is also happening that many of the IPs are not holding even a single penny share in the IPE. Correct. That is also happening. So to combat those problems,
no, but those will be associate partners, sir. If you are a designated partner, nominally आपको कुछ तो रहना पड़ता है.
नहीं, इस टाइम कोई रिक्वायरमेंट नहीं है, सर. As of now,
कुछ तो maybe 50,000, 1 lakh rupees that
हाँ,
not solve the purpose.
वो रहता है, sir.
So that is वो 50,000 ही हुआ ना सर, 50,000 इज नीदर
हाँ,
हियर।
प्रिसाइजली अभी भी जो अगर हैं जिस आईपी में मैक्सिमम कोई आईपी में एक या दो पार्टनर की ज्यादा होल्डिंग होती है, बट द आईपीई एलएलपी कैन वर्क विथ लार्ज नंबर ऑफ पार्टनर्स गिविंग
यस
नॉमिनल स्टेक 1%, 0.5%, 2, something 0 point some percent.
Shantanu sir, what is your suggestion?
So my suggestion is rather than insisting that each IP must have minimum this, which means you're saying any IP has to be formed with minimum 20 partners. जो मेरे को इसमें सीधा समझ में आ रही है, तो मुझे ऐसा लगता है कि मे बी देयर कुड बी अ फंडिंग पार्टनर बट और a shareholder type of a fellow, but the voting right should not exceed 10%. सो प्रोपोर्शनेटली वो वोटिंग राइट पे थोड़ा कैप हो जाना चाहिए। उससे मेरे हिसाब से काम हो जाएगा। जैसे थोड़ा सा बैंक्स में चलता है ना, कोई सिंगल शेयर होल्डर का ज्यादा ये नहीं होता है, मोर देन ओवरवेलमिंग वोटिंग शेयर नहीं होता।
So
उस
there are
टाइप
very few decisions in a company in IP where votings are required.
दैट इज ट्रू सर, बट अल्टीमेटली एज ए आईपी ये आई थिंक मेरे हिसाब से इसके लिए हो रहा है कि नाउ दे वांट आईपीईज टू टेक मोर असाइनमेंट्स रादर देन
Yes,
इंडिविजुअलाइज,
yes,
राइट? तो
yes.
अगर एक फर्म के नाम पे आपने असाइनमेंट ले लिया and let's say the partner handling that thing has hardly 1% stake or nominal stake, so they are saying ki boss uh, that partner becomes really liable and all that, but maybe he is not the decision making authority. That is right, क्योंकि जिसके पास मेजोरिटी शेयर होल्डिंग है, he will be having the final say in the matter of that case and all that. This is what probably they want to say. Could be true, may not be true, that I don't know, but ये हो सकता है. So that's why they are trying to correct. But 20 partner, that means are they saying कि 20 partner minimum चाहिए?
Sir, can I say a few words, sir, if you permit me, sir?
Yes, certainly, sir.
Sir,
No, they are not saying कि 20 partner चाहिए. This is not there.
Sir, what I understand from this, sir, I'm Tavinder Pal Singh Arora. Why I understand here is suppose I take dummy IPs only to make an IPE. So उनका स्टेक 1% है या 0.5% है, तो वो डमी पार्टनर्स को अवॉइड करने के लिए लगता है इसको दिया है। लाइक सपोज आईपी हैज 18 मेंबर्स, तो इक्वल आएगा उसमें, कम नहीं होगा उसमें। तो 5% मान लीजिए पेडअप 5%, 5 लाख सबने दिया, 1 करोड़ करना है और 21वां मेंबर आ गया, उसने भी ही ऑल्सो पुट्स इन 5 लाख ऑफ रुपीज, तो 1 करोड़ 5 लाख इज द पेडअप शेयर कैपिटल। तो परसेंटेज अल्टीमेटली जो वो उस is equally distributed in the 21 members. But where lesser number of members are there, there this problem must not be there. When the number of members are many and some dummy members are there, which are not directly involved, I think keeping that in mind, this has come. This is what I suppose, sir. Where 5-6 members are there, the equal contribution will be there in that case.
Fine. So you have any suggestions, sir?
I think, sir, this is good for the large number of members, but if the number of members are lesser, then they should add here that they should have the equal contribution, or a minimum threshold can be given, like 10% or 15%, whatever, depending upon the number. Some formula should be given in that. This is what I propose, sir.
Right, sir. Thank you, sir.
Nilesh, I have one question.
Yeah.
How do they fix the liability of an individual IP who is a partner or a director of an IPE as well? Is he severally liable with it? Because in
No,
a
no, sir.
company or an LLP, the liability is limited.
No, sir. If there is a partner, IP partner, who is an IRP or RP, and he is doing any mistake or any act or omission, then that particular partner and IPE, they both are severally liable, but not other partners.
Okay.
The persons who are not related with that transactions, they are not liable.
But as an IPE, their stake is liable then?
IPE is liable for the conduct of its partner or director, but not opposite.
Okay.
Sir, actually,
I'm Pradeep Singh.
Jay Pradeep.
Actually, I had made given my comments in the chat.
Yes, sir.
My
Yes, sir.
my fundamental objection is, I think what I say is that actually IBB they can prescribe the eligibility requirements that the majority of the members have to be IP in an IPE, and the minimum capital requirement is fine. But they cannot, they don't have the legal right to prescribe on the contractual part of the how partnership will be run, how many partners will be there, how much capital will be contributed by each partner. That is beyond their remit. And I mean, we also run, law, firms, there in partnerships. There's no such requirement that we have to have this much of, partner capital contribution. There will be some person who will be bringing more business. There will be some person who will be providing more back-end support. Accordingly, the partnership shares will be decided, and the capital contribution will be decided. So that's not the remit. That is number one. Number two, so though this IBBI note does not really, it's quite ambiguous in terms of what exactly the problem is, but the solution provided is not a solution for any kind of problem, whatever may be. So if I am not, my partiality is in question because I am a 1% partner. How can I become, totally impartial if I am having 5%? There is no logic behind that. So my suggestion is we have to specifically say that this proposal should be scrapped. I mean, it makes no sense. That's all. Thank you, sir.
Okay. Thank you, sir.
One thing I would like to add here, sir, if I am permitted.
Yeah.
See, the IPs are not only SFA from the SFA side. The IPs may be from the plant and machinery valuation side, from the land and building valuation side also. They have become IP also. Now the liabilities is to be counted severally and individually in this case. That also should be taken care of in some way or the other. So this is my one suggestion is there. How can it be done? I have not thought of it right now, but this had come just now in my mind, because I basically belong to plant and machinery valuation, and then I became IP. So if I am there in the IPE, then what shall be my role? That also should be clear in this amendment which has come now. If I get to know, I'll just definitely share in the group only. Right now, I'm not able to think about it, sir.
Sure. Thank you, Mr. Kameshwar.
Thank you very much. I am from Hyderabad.
Let Mr. Parveen speak, sir. Then Mr. Rao, you can take it up. Parveen ji, please go ahead.
Yes, sir. Sir, my view is on this. By fixing the percentage is not going to help anything, because if you see, what they are saying is that the person who has to be partner should have a minimum capital contribution. When they are fixing 5% or 5%, or they're saying they're more than 20%, say they suppose there is a 1 crore rupee capital is there, correct? So if 20 partners they are envisaging, that means 5 lakh capital minimum is required from one each. And when it is more than 20, then probably it will come down to 2 or 3. So it is always better that they should fix up a threshold amount, say 5 lakh or 10 lakh. Then now going into these percentages, that because ultimately they are introducing this concept that the partner should have some ownership stake into that, so that it should not become a dummy partner. That's my view.
Thank you, sir. Thank you.
Yeah, Mr. Kameshwar Rao, please.
Yes, sir. Good evening. My intention is that all IPs are individually getting the assignments on IP as IRP or an RP. The intention was to start an IP so that collective knowledge is available, so that more number of people will contribute for the assignment that is coming with background support or individual knowledge wise also. Now, fixing a capital criteria will become a negative issue for this particular one, because many people may not be able to invest that percentage of 5 lakhs or 10 lakhs to be invested in an IP. So one thing they can do is that any IP should be a member of an IPE to get an assignment. That much is sufficient, so that members are available in IPEs only, where they get individual assignments, but in the name of IPE. Individual only it will come, but they will be working in IP, in a as a partner or a director in IP only. And this percentage of capital contribution should not be there. That's what my view.
I will take the last query from Sonu Gupta, and then we will go back to Mr. Grover. Sonu Gupta ji, you have written some comment on the chat box. Would you want to elaborate it?
Sir, good evening, everyone. Sir, in my humble opinion, even if it's a 5% shareholding, which is only 5 lakh rupees, if 1 crore is the cap we are taking, I don't think it will take away the nuances, because somebody will be still holding about a very big chunk of the shareholding. So what has been envisioned in this proposal, as our learned friend also mentioned it earlier, the object is not achieved, in my humble opinion.
Thank you. We noted all that. We will be assimilating all that. Back to Mr. Grover for his concluding remarks, please.
Yeah, thank you, sir. So thank you everyone for giving your suggestions. So what I understood, basically, most of the people are not happy with IBBA, this discussion paper, as always happens. So we are not happy with the discussion paper, but it will be there. So it is better that we give suggestions. They are not going to scrap this paper. Of course, they are always open for the suggestions. So it is better that we give suggestion. One suggestion, which is a very valuable suggestion, that in case of lesser number of partners, then still 5% will ultimately lead to a skewed secured equity in the hands of few people. So that is a very, very good suggestion that has to be, we will assimilate and find out what all are useful, and we will submit to the IBA. But this one suggestion was quite a good suggestion. So I think that is all from my side. So
thank you. Mr. Siva Prasad, you may please put your comment on the chat box, and we will include it. We are very short on time, so we won't be able to discuss it further. So with that, we thank Mr. Jalish Grover for being here with us for the discussions. Now I will hand it over back to Gauri Deshpande, and you may do the presentation, please, to Mr. Grover of our memento, the virtual presentation, please.
Yeah, I know.
Hello.
Yes, go ahead.
Thank you, sir, Grover sir, for your insightful discussion. And this topic is much debated, and we had got much queries in that. And here we are presenting you the memento from the IPNet, and
I'm sharing.
Thank you, Jalish.
Yes,
Thank you, sir.
can you share my screen?
Yes, we will be sending it across the office. Thank you very much for being here from Mr. Makhija and the IPNet. Thank you.
Thank you, Ji. Thank you very much, sir.
Thank you, Ji. Thank you. Gauri, you may take it down, and we move to the next topic now.
Okay.
Mr. Deshpande.
Now the next topic for our today's discussion is strengthening the valuation process under IBC 2016, and for that we had got a very learned professional today, CMA Harshad Deshpande. I request Patwardhan sir to please introduce him.
Thank you. Thank you. Mr. Harshad Deshpande, a good friend of mine, is an MCOM fellow member of the Cost and Management Accountancy. He is a CISA USA, is a company secretary, CIMA UK. He is also an independent director, insolvency professional, and registered valuer. He has been practicing in his firm, Messrs. Harshad Deshpande and Associates, and they are practicing cost accountants, cost and management accountants since more than 15 years, having wide experience in insolvency laws, valuations, indirect taxes, banking, finance, etc. Professionally, he has been advising many major Indian companies and multinationals through all these areas. And his area of work has been, as we are all aware, cost and management accounting, insolvency, and valuation. He also has keen interest in academics and training, and he has committed himself to welfare of the community by engaging with the community. He is also has represented in the past the Pune chapter of the cost accountants and also on WIC on various forums. He has done research projects which have been very widely useful, and they were conducted by WIRC of ICWAI. He has written many articles, and he is also engaged in extracurricular activities, has been a member of NINAD in Pune. So with this brief introduction, I would also add that he is also advisory committee with IPA of ICMAI, and also member of the Valuation Standard Board and member in advisory committee of ICMAI, Registered Valuers Organization. So with this brief introduction, I welcome Mr. Harshad Deshpande for discussion on the IBBI's paper on valuation. Stage is all yours, Mr. Harshad.
Thank you, Udayaraj. Am I audible?
Yes, you're audible, sir.
Yes. So I thank Dr. Makija and the IPNet community for immediately bringing out with this webinar. I myself am a good follower of this community, and this particular domain, insolvency and valuation, it is an evolving field, and we have to from the experiences, and we have to also learn from the experiences of others. So it is that our community, it is that our interaction which makes us better and assimilate knowledge, and that also improves our IBC. So with this brief one, I would like to just present that paper. But for that,
some people are complaining about low voice or some disturbance in the background. Can we do something about it?
No.
Hello. Yeah.
Is it better now, sir?
Far better, sir. Thank you. Yeah.
So I would like to just thank IPNet community that bringing up such webinars, and Udayji and Makijaji has done a fantastic job in bringing up these sessions, which are quite helpful to all of us. So friends, this topic perhaps this discussion paper is a bigger discussion paper about the valuations, and there were in fact I would like to just bring to your notice that there were many proposals that were in fact initiated as regards to the improving the valuations in the IBC domain. So out of that, you can see that this discussion paper has let down these 5 proposals. So I'm going to show you in a presentation form, because this discussion paper is little bit detailed, and you can also find it on the IBBA website. So I will just share my small presentation, and we will discuss the key aspects of this discussion paper. Just allow me a second. I hope this screen is visible.
Yes, it's visible, sir.
So this is the valuation reforms in the insolvency framework. That is the strengthening of this valuation process under IBC. This is what the discussion paper talks about. This valuation reports are of course central to the insolvency resolution, and this report guides the COC in evaluating the resolution bids and also making a certain crucial decisions. If this valuations are inaccurate, obviously this whether it could be high, that would lead to perhaps or low also, that could lead to some wrong conclusions, and that will be perhaps misallocated resources, and also ultimately impeding the economic growth. So obviously, IBB has been very concerned about this, and you can also see in the various litigations that is happening in and around valuation. So that is perhaps forced IBBI to bring this clarity. Uh, this fair indication of the value of assets can only be achieved if the valuation of the CD is carried out in an objective, transparent, and credible manner. Friends, so we always say that valuation is a subjective exercise, and each valuer will have its kind of his own opinion, his own thoughts about the value. But nevertheless, in order to have conclusive decisions, it is very important to have some objectivity. And in this discussion paper, this aspect has been taken care of as well. So there are in this discussion paper, there are 5 proposals which are being discussed. So number one proposal, and of course it aims at having a better credibility, strengthening the credibility, consistency, and comprehensiveness of the valuation of the IBC under insolvency framework with the global best practices. So these 5 proposals, we are going to see each one of them. So the first proposal is the standardization of the reports, that is the uniform format and mandatory documentation across the process. I will come back to this in my subsequent slide, what this proposal says about it, and what are the benefits what we can get, and also the challenges which we could face. The second is perhaps harmonization of the standards. So this is a kind of within the rules and CRP regulations and regulation regulations, there was a some kind of uh, uh, the approach, the valuation approach, or the use of the standards. There was a some anomaly which has been, I will say that, has been removed in this proposal. Then most importantly, revised fair value definition. Okay, now this fair value definition has been changed, and perhaps it will bring up uh, more of intangible assets and synergistic enterprise value. In fact, while the discussion was going around, and being this ICMA review was also a big part of it. So one concept was we were trying to suggest is that enterprise value, which perhaps in our case it is not there. We are having a summation of 3 different class of the assets. So this is the proposal which was made, and of course this because of the structure of the law as of now, we could not have any solution. But the fifth proposal that has been taken care of. Then the second, this fourth proposal is about the single valuer option. So in case of small debtors or small corporate debtors, especially MSME companies, so the question was that do we really need two valuations? So that has been proposed in this discussion paper. And the fifth point, which I said that it is coming out of that fair value, this enterprise value concept, is the coordinator valuer role. Okay, so there is a kind of one coordinator valuer who will aggregate the values, and in addition to that, he can also have the choice of adding, because we always say that 1+1 is 3. So that is how the valuation works, and the role of the key coordinator valuer would be assessing that enterprise value aspect. So we will come to that when we will run through the presentations. So I move on to my next slide. That is the proposal number 1. That is the standardization of the valuation reports. Friends, although the rules of valuation these are being set, there are contents of the valuation reports. What valuation reports should contain? That is based in the that is written in the valuation rules. Okay, so these contents are there, but it was observed that although these contents, mandatory contents are there, there are certain aspects which perhaps not covered in that mandatory aspects. So in order to capture, and in order to have a uniform, because one valuation report is having some different content, and second is having a different content, in that case it becomes very difficult for the COC to and even for RP to assess that what is the fair value and liquidation value. So that also brings out the disputes. That also brings out the need of engaging one another set of values, or one third value we call it, and that also perhaps adds to the cost. It also adds to the timeliness, and sometimes that also doing also that we find that he may come about with some different kind of approach. So in order to curtail such things, that IBB has proposed now that instead of having a principle based approach, it will have a rule based approach or a format based approach. So what IBBI has mandated is that the uniform format for the valuation reports and mandatory document requirements and across the IBC processes, that is CIRP, liquidation, PPRP, fast track, and voluntary liquidation and personal guarantee, as well as the bankruptcy. Okay, what could be the impact? The expected impact is that the greater consistency. So it is expected that the reports would be more consistent, and most importantly comparability across the cases. So in that case, this once you have in a particular format, it is easy for you to compare and also find out the differences in value as well as the premises, which will enable you to have a just like we have the concept called as a uniform costing. Okay, so it will be like uniform valuation reports which would be structured, and this will enable the COC and other stakeholders to take appropriate decisions. It will enhance the transparency because the mandatory contents perhaps they were not sufficient enough to cover the all the aspects of the valuations. So it has been increased, and there is a format also now. IBB has come up with the format. If the time permits, we will go through the formats. In nutshell, I would like to tell you that the mandatory requirements of the valuation reports. So there were 14 points. Okay, so these 14 points were there. There's a mandatory points which we have to write in the valuation report. So these were kind of a principles that you have to cover. Now IBB has come with that the formats which has part one, in which you have to document the various the documentations part that you have to carry out. Then mandatory contents they have proposed what it should be there, and also they are having a format that this is the proposed format. So it has got executive summary, and in detail you have to write down all the points which are mentioned in the format. So this will give us a better understanding of the valuation report, and this will bring a lot of uniformity. It will be very easy for the regulatory oversight, and it perhaps would reduce litigation risk that we are having as of now. The possible issues, the risk of over standardization may not capture the sector specific nuisances. So that always is there, that these formats are being generalized, but these formats may or may not be useful for a certain class of companies. Suppose I take the example of this uh, financial sector, or any financial service provider, or any aggregator, or any IT company. So these perhaps propositions or the standardizations may not yield the the results. So that kind of freedom what was there for the valuation, so that would get perhaps that would not be there. Increased compliance burden for the register values. That is true. That it will, as I mentioned, that from 14 it has become 23. So that almost the disclosure portion and the working portion, it is going to get increased. Many times we have seen that under IBC, these cases actually do have nothing. In the most of the series, you see that you asset side, you will find that there is a balance sheet maybe 4 year, 5 year old, and you start the valuation process. Then most of the cases, IP will respond to you that this Section 19 application is being filed and there is no cooperation, data is not available. So in that case, this perhaps this compliance burden would be there, that you have to again RP and also the valuer both need to make appropriate disclosures. So that is that remains the issue. And potential delays is the formats are too rigid and complex. So this formats, if you see, for example, I was just going through being a SFA valuer, that it contains a column like date of inspection. Now what happens is that there are different assets. Suppose there is inventory. So in that case, whether I should write a different dates for different assets or what? In some cases, I don't have any assets. If there is no inventory, there are only current assets and maybe some bank balances. So should I that inspection date? So should I take the what is the bank date, or it is expected that the valuer should himself get a bank statement, or he should rely upon what is the statement given by the RP, and what would be the date that I have to write? So these are the certain points which perhaps because of the detailing of the formats are now coming up. But I suggest that these formats they will give a lot of information, and as a valuer, if you are stuck with some of the documentation, it is always better to disclose in the right manner. So that will perhaps that could be expectation from the IBBI from the valuers. So this is the first proposal, that is the standardization of the reports. Just I will take 2 minutes and just show you that one format so that you will understand it clearly how it is going. So I am now sharing with you the format. So this is the format circular that has come. So as I said that this contains two parts. The part one contains of the document requirements. The second part contains the minimum content of the valuation report, and the third C part contains the key parameters. And this part two, it specifies asset specific formats for the valuation report. As you are aware that there are three asset classes: land and building, plant and machinery, and securities or financial assets. Okay, so let us go through that first general content. So it is a documentation. I find that this is very much there in the present valuation rule, that you have to maintain the comprehensive written records of the valuations. So that is there. That documentations you have to maintain, which will describe the valuation process, and it will substantiate the conclusions reached by him. Then the communications not limited to records with the client, but additional data inputs evaluated. And the last part, the documentation clearly set out the valuation process undertaken and the manner in which the valuation risk was identified, assessed, and managed by the regulator. Now come to the second part, that is the minimum content of the report. So here I was mentioning to you, now they have mentioned 23 items, which was perhaps less number in earlier valuation reports. So purpose, scope, it was there, registered valuer, name, number, the other expert required, disclosure of the interest, conflict of interest, appointing authority, intended use, details of asset liabilities being valued, background, valuation, currency. This is the addition that now they have added this portion, that it may happen that the currencies are different. So in that case, you have to disclose that. Then VRIN number, which was later on introduced. So it was not, although IBBI mandated it, it was not in the rules. Now by virtue of this circular, you have to mention this mandatorily. Sources of information, premises of the value, valuation standard followed. So this valuation standard followed has been added now. Earlier it was not there. So you have to disclose that what valuation standards you are following. Then point number 15 also, relevant discounts and premium. So this also point they have now added, because many times it was observed that the calculations were there, but the key numbers of the premiums and discounts, it was not there. Then the sources and selection of the significant data and input use. So earlier it was just the sources. Now it also says that selection of the significant data. So you have to also apply your mind and select the what is the significant data. Then description of the inspection and investigations made. Then this point number 18 is also new addition: sustainability and functional factors in impacting the valuation. So this is one more aspect perhaps the valuer has to look at into, and I'm sure that it will be a lot of thought process we have to undergo in order to comment on this point, and it is a mandatory content, so it is for perhaps you cannot miss upon it. Then significant or special value assumptions or limiting conditions. So earlier it was just assumptions and limiting conditions. Now it says that special assumptions if you any made. Specific reasons for any asset being left out or assigned zero. Now in that case you have to, this was one more problem. in that current format of the valuations of certain class of assets, they were missed out. The LB valuer used to say that this is a SFA item, SFA valuer used to say that this is a PM item. So like that, there was a left out. Now in that case, if there is a left out, that you have to clearly disclose why it is left out, or even if you have assigned a zero value, so that you have to clearly write. Then findings of other expert involved in the valuation. So not only you have to write who is the expert involved, but what is his finding. So that also you have to write it now. Value and rationale for valuation. So this is also one more addition that they have done, that you have to explain what is your rationale for valuation and value assertions. And the last point, caveats, limitations, disclaimers. So there is a guidelines which were issued in 2020. So that was not there in the valuation rules. By virtue of this discussion paper, this they want to include in the valuation reports itself. The C part of it is the key parameters. So again, this list is it consists of the, for example, you are valuing the receivables. So the trade receivables, what type of receivable it is, whether taxation related receivables, including carry forward of losses, the applicable regulatory framework, whether it's a prudential norms of RBI or it's the Companies Act, then credit risk profile and related party status. So this is also one more addition that you have to include in your valuation report, that solvency status, whether that receivables are from the default or in the under litigation, or it may happen that there are companies from which there are receivables, those are also under the insolvency or CIRP process, or maybe a liquidation process. Aging of receivables. So this is actually it was a part of the working papers of the valuers. Now they are suggesting that this should aging also we should be giving. So it also burdens the IPs, because what happens is that you have a data. Now receivables data is there in the balance sheet. Now you have to go to the CD and his account books of accounts, find out the aging, and that perhaps would be a additional information the IPs would like to have from the CD, and that information has to be passed on to the valuer, and he will be disclosing in his report. Legal enforceability and documentations. Status as whether secured or unsecured, disputed or undisputed, available with the enforcement documentations like valid contracts, invoices, acknowledgement of the dates, KYC address of CD, and etc. So you can see that this list, we're just talking about one head about the receivables, but this list is long. So it will be that way a cumbersome exercise. And if there are multiple parties, then of course the challenges will be even bigger. Then past recovery and service record. So historical recovery experiences from similar type of receivables. Okay. So whether that customer has been already paying you on time or not. So these are the facts that you have to take, whether there were any litigations, where any legal costs or administrative costs was incurred previously. What is the time of the recovery? So what is the kind of payment pattern? That also you have to have a look. Then only you will be able to have these parameters, and based on that you can ascertain the value. Then macroeconomic and industrial factors. So sector specific default trends. So it may happen that certain sectors, they may be having certain issues. For example, say let's talk about sector like metal. So some days back, there were in a lot of problems. So in that case, you have to identify as a valuer that what are the macroeconomic factors and sector specific factors that might impact the not only this city but as a sector, and economic conditions impacting the recovery of receivables. So for example, this pandemic like corona comes in, so that they're expecting that we should write. It may happen that certain countries, they have certain issues. For example, if you are there is receivables from say a country like Bangladesh, okay, so it is presumed that you will write in your report that this is a macroeconomic factors, and that would perhaps impact recovery of the receivables from such kind of parties. Okay, so you can now have a feel that this valuation report is going to be a very detailed one, and it will, according to me, it will take a time. It will also require a lot of resources. It will also require a lot of inputs from the IPs, and also we have to now have these points included while we write when we take over the assignment as a IP or as a liquidator. So these points are also you have to add in your list and perhaps press them to give this kind of information. So this is the land and building report. So this is the executive summary. So there is nothing new about it. Uh, More or less same. Only thing is that they have detailed. They have written that you have to write this fair value liquidation value in a objective form. Many times this was also observed that there were number of values which were written and which one is to be taken, that many of the values were not objectifying. So this we have to now say it. You have to also write a VRN number and also your status of COP. So perhaps here COP would mean that the registered value of COP. Okay. So this is the format. This is, as I said, a very detailed format, and the if I start going into that, perhaps the time is not sufficient. So for the time being, I will just skip that part, and I will move on because we have to discuss other four proposals also. And of course, this you can always put your comments about this formats and this particular detailing. And from IPNet, Udayji and Ashishji will be compiling all this, and we would say this, send this to IBBA if required. From our RVO also, we will submit this our views, suggestions on this particular aspect. As you know, one aspect which perhaps I feel that it may happen is that it it will increase the effort, it will increase the time, and it is going to increase cost as well also. So right now, what perhaps the cost patterns or the valuation fees you are seeing, I feel that there would be a significant increase because of this kind of retailing. Okay, this is of course my personal view, and IBB has very clearly mentioned that this fees would be a market driven. So there is no like a minimum fee in case of a valuation what do have in a insolvency assignments, right? So I will just come back to my presentation and go to the second proposal. So the second proposal, as I said, that this second proposal was a more of a harmonization. Okay, so the valuation standards. The current challenge was that under CIRP regulations, it was mentioning about it has to be done with respect to the international valuation standards, and in the liquidation regulations, it was saying about the realizable value as per the Companies Act or registered value rules. So as per registered value rules, perhaps you had an option of having choosing a standard. So what IBI would like to do that it has to bring harmony. So the current challenges were dual standards, creating confusion. So what used to happen is that because of the change in the standards, it may happen that the same value or same CD, the results would be different. Of course, that results could be different on account of time, but also it was observed that just because of the application of a different standards, the valuations were changing, and this perhaps is a requirement that was this issue was earlier discussed also. So by virtue of this discussion paper, that harmonization of the standards will happen. So it will be replacing this single and broad specific valuation standards across all the processes and bring the uniformity. So the uniformity will be there in all the stages, CIRP, liquidation. Then it will of course have a reduced disputes and the improved reliability of the valuations. The implementation considerations, it could be the transitional changes that may happen, but most of the values I will tell you that international valuation standards they are aware. So I don't find a much challenge in implementing this proposal. So next, and the important one, is the revised definition of the fair value. So this proposal, it uh, it proposes to expand the definition of the fair value to include the intangible assets like brand equity, intellectual property, goodwill, and customer relationship, plus synergistic view of the corporate data as a whole enterprise. So what it says is that now currently we are morely driven by the asset based approach, or we call it as a cost approach in valuation. So what IPBI proposes is that, so you will find that maybe 90-95% of the valuation under IBC has been done by the cost approach or the asset net value approach, we call it NAV method. So what happens is that in that the assets of the company are valued based on the book value or based on the cost which has been incurred for that asset, whereas the real value could be different. In fact, the companies, especially say startup companies, we are talking about say a company like Byju's. So you will see that the value perhaps is not the just summation of the assets of the maybe they be having some laptops and computers and some other related infrastructure. Maybe they will be having some servers. So the asset value of that company is not limited to the value of the assets, but it is much bigger. So that approach perhaps has been missing in the IBC, although there is a provision to have the approach as you can go by market or the income approach, but it was seldom used because of the different categorization and current kind of scenario. So what it says is that now you have to look beyond, and you have to look beyond for the things like brand value or the long standing of the business. So that also is sometimes advantages. Just to add to this, for example, I was doing a valuation and I could find that a company, it was being valued and it actually fetched much more value. Okay, so the reason was that that company was having a good order book. Rather, before that, it had a vendor code and it has got a good background in certain state enterprises. Okay, so any buyer, any auction participant, you would be interested in acquiring such company because that gives them an additional benefit. So this benefit was, as of now, there was no provision to incorporate in the report. Now with this proposal, with the increase of the with the expansion of this definition, the valuer will be able to include that in his proposal. I find that one more reason it is not there, but especially if it is a liquidation case, you will find a listed companies will get a good value. Okay, so these companies, as of now, this value is hidden value. So IBBI would like to bring it to the notice of the stakeholders, and that is why perhaps this provision, this proposal they have brought to uh, change the definition of fair value to include the other assets. So the advantages would be that holistic valuation. So it will bring more comprehensive value assessment reflecting the two enterprise worth beyond the physical presence or physical assets. Better benchmarking, the improved evaluation of the resolution plans with the market relevant valuations, and the global alignment. So international valuation standards also talks about this enterprise valuations, which consist of the synergistic value or the intangible value. So that will align with the global scenario. However, here the issue is that while valuing such assets, for example, I said that how to value maybe the long standing of the business, how to ascertain the value of the listing status. So for that, a new dimensions has to be evolved, and perhaps there is a need that once we start these proposals becomes a reality, then we will start realizing that this valuing this kind of assets, there is a lot of subjectivity. You will see any intangible assets. I was talking about the startup like Byju's. So there could be a divergent views. You know, everybody, one valuer can have a different view, another value can have a different view. So that perhaps the subjectivity will be higher, the complexity will be much more higher, and which may lead to the disputes and of course the cost. As I said, that definitely will go higher, and the possible instances if there is a lack of the expertise in intangible values. So this typically is the case with the other category. See, as a SFA valuer, that is a part of our syllabus and we are doing it for the number of years, the intangible assets. But this perhaps the other category of values, land and building and plant and machinery, they need to learn this concept in a much more deeper manner, and perhaps that is something that is the capacity building that the valuers would like to have it. So I'll go to the fourth proposal, that is the single valuer for small corporate debtors. So as of now, we are doing, as you are aware, that under CRP we are doing two valuations in all the cases. Now the proposal has been brought that there is no need of two valuers for a company who is a MSME or a company who is having a turnover of 500 crores or less in the latest available financials. So in that case, it is proposed to have a single value. Okay. The idea is, of course, to reduce the CRP cost for the small debt size, the faster valuation process and streamlined procedures, and significant relief for the MSME struggling with the CRP cost. Okay. Uh, Here they have given two options. Either they have proposed the threshold of 500 crores of last financials. Okay, so there is a trick. Now many companies going under CRP, we will find that the last financials, maybe it may be 3-year-old, 4-year-old, 5-year-old. Many times it may or may not be available. So in that case, what to assume? So that becomes a challenge. Many times the company do have financials, but they are not audited. So whether to rely upon such kind of a turnovers or not, that also would be a challenge. So the other option is that if a company is registered as MSME, I find that that is a better proposition, because in the definition of MSME, rather this when this was introduced for this in IBC, the exemptions for the MSME, a lot of things have been cleared out. Okay, so what cutoff date should be taken, what is to be done by the RP, and so CD. So that is well clearly spelled out. So I feel that this MSME would be a better one. That is what my personal opinions. Of course, some of you may or may not agree with it, but finding this 500 crores threshold would be a very challenging for the RP. That is what I feel. The benefits, of course, there are also concerns that since there is a single valuer, there could be a risk of bias or error. That is, there is no cross checking because there is a single valuer. The potential disputes if stakeholders question the accuracy, and the threshold criteria, as I said, that it needs a kind of refinement, or this MSME criteria, if it's to be applied, uh, then in that case it has to be clearly spelled out on what date you have to check that status of the MSME. One more aspect which perhaps they have.
Harshadji, we will have to conclude it because I will have to call for comments also. So I would
Yes.
request you to
Sir,
highlight the
just
critical points.
one
And then we
slide
can.
I'm having, then I will be
Oh,
closing
sir,
up.
thank you, sir. Thank you, sir.
So one point I just would like to bring to your notice, that reduce CRP costs. So I find that having a one valuation report more, I don't find that there will be that kind of a significant value saving. But anyway, it's a call of the regulator, so we have to follow it. And the last paper, that is perhaps what I was discussing, is the synergistic value. So the proposal was to have an enterprise valuation, but in the current existing set of rules, that it could not be having, because that there are three asset categories that's being prescribed. In fact, nowhere it is like that, but in India we have these three categories which has been defined in the rules, and we have to follow it now. So what is to be done now? For what they have come out with is that coordinator valuer. So in this one more thing that they have recognized in this paper is that each set of values, okay, so you have to work in a sets. So although there would be three values, but you have to formulate a sets, and out of that set you will be designating one valuer who would be a coordinating valuer, who would add the values of two valuers plus add intangible assets or other synergistic value, and that would become the total fair and liquidation value. That is what the proposal says about. Okay, so who could be a coordinator valuer? According to me, it could be anybody. It could be a SFA valuer. I mean, by default, we say that SFA valuer could be a aggregate fair valuer. But according to me, if the value of the land and building is more, you can LB valuer can become a coordinator valuer, or the plant and machinery is bigger, then PM valuer can take over this kind of rules. So this idea is that the it captures the synergies and intangibles to give the more accurate market rated valuations. However, the increased coordination will be a complexity, that who should be a coordinator valuer, whether that again you difference between the two coordinated values thought process and the variation, if it is more than 25%, it proposes to have another set of values. So that is also one thing. So this is what perhaps is the, I will say that step forward to get an enterprise valuation on board in the IPC. So in as I said that this time is really rather this to discuss this is lengthy topic, but I thank all of you for your patient listening, and I hand it over to Udairaj for the discussions about the next paper.
Thank you. Sir, you will be required to, of course, conclude. We have very less time. I'm aware we should have given more time to all these papers. In fact, each paper is worth 2-3 hours of discussion minimum, and we are trying to fit in all 3 papers into one discussion of 2 hours, which is little not doing justice to it. So we have certain questions put up by many people on the chat box. So anybody who wants to speak, I would request them to put their question on the chat box first, and then one by one, they may quickly put up their suggestions out there. So I will start with Mr. JKV Rao, who has put up a couple of questions there. Mr. Rao, please. You're on mute, sir.
No, what my suggestion is that this valuation format, which is proposed to be standardized, it should contain certain issues like whenever there is a significant variation from the realized value of the mean, that is only to postmortem only in one case, and the other case in the we can obtain valuation reports at the time of sanction considered by the banks, and the valuation report given during the CIRP or liquidation, so that what could be what is the reason for
Sir, those provisions already exist that RP can seek
then
those
I think
reports
bank
and
valuations we are not I mean
sir,
considering in the
sir,
value.
that is already there in the regulation. You can go to regulation 4 and RP can obtain those valuation reports from the bank. So those provisions are already there. So you can refer to
This
that
is
and
about
ask it from the RP. And
okay.
RP can get it from the bank.
Yeah.
Those provisions already exist, sir.
Okay.
Okay, thank you. Mr. Shantanu Rai, please.
Yeah, sir, my question was what I have seen in most of the cases that I have handled, which are little, the companies were closed for quite some time. The sundry debtors data is very sketchy. How, in
Yes.
that case, how can a valuer do justice? In many cases, this data is not really available properly. Though IBBI is making lots of regulations where to get the data when the data is not available. And how will the valuer do the valuation? Second question was during liquidation, shouldn't the valuation be done individual asset wise because they have removed the concept of sale as going concern? And thirdly, how in liquidation a listed company's a company's status being listed would add any value? Because are they saying that you can sell the shell company instead of dissolving it? These 3 questions I have.
Yeah. I will redirect those questions to Mr. Deshpande because he must be facing those issues in that RVO. Many people coming to him with this query.
Yes, sir. So I just missed your first question, sir. Can you just repeat that?
Yeah, sir. My first question is, in many cases of insolvency, when the company is already closed for a few years, the data, particularly of the sundry debtors, that is people who owe the money to the company, there they show a lot
I
of
recollect your question now, sir. This would be a real challenge, and interestingly, this topic, because you will find that there is a lot of litigation happening in that this thing. Lot of cases that in which you find that there is a PUFE or the transaction auditor saying that this perhaps invoices are not genuine. Okay, so there are certain cases wherein you will find that the other party has never acknowledged, especially the other there is a billing to the state government or even PSU. Okay, so in that case, I feel that this is going to be very difficult to implement, although the IBPI is mandating that this should be there.
Yeah, that's
The
why.
RP, you are aware that you know how difficult it is get to that this kind of a data.
Probably,
And,
sir, I should say that as valuers and RVEs or whatever is your association, you should make a representation. Because let's say you write off all this. Because if it is sketchy, you must brutally write it off,
correct,
though the company has not written it off. But then you should not be accused of being giving undervaluation. You
correct.
know, so something needs to be done. This is just wishful regulations. I feel idealistic situation, not grounded by practical realities.
Yes. To add this, I would invite Mr. TV Siva Prasad, who talks about aging receivables. Mr. Siva Prasad, you may join this discussion here.
Good evening again. In one case, I was a valuer in a CIRP case. The RP had supplied me the aging of the debtors based on which I have done my valuation. Likewise, in my current liquidation assignment, I had given the aging of the debtors to the valuer. Likewise, it should be the responsibility of the RP or liquidator, whoever he is or she is, to provide the aging of the debtors, based on which the valuer can submit his report. And as I noted that most of these formats compare to the format given by the international valuation standards. There may be some more additions, but more or less it is on the same lines. And some
Yes, sir,
of
go
the
ahead, sir.
provisions seem to be very illogical, like I don't point F for part C. Right now, I'm not able to recollect what exactly it is. It seems it is illogical, and unless the data is provided by the RP, it cannot be explained or covered in the report. And
Right.
another thing, say single valuation. I always feel that there should be single valuation for small kind of insolvency case in assignment. But the threshold of 500 crore is, I think, on the very, very higher side. It may be restricted to 50 crore or at the most 100 crores only, but not 500 crores. 500 crore is a very significant amount.
Can be an
These are all my
MSC.
suggestions.
So, sir, I want to come in again with what Rao sir said right now, that it should be the duty of the liquidator or the RP to give all this aging. Now, my biggest challenge is, where do I get this data? Despite filing 19.2 and several this thing, most of the time the data is missing, hopelessly missing. And
Yes.
much of it would be concocted also. That's why it is missing. Okay. So, then what will happen with all this? The RP will keep on blaming the valuer. Valuer will put up the hand and say RP ne diya nahi, and the things will remain very inconclusive. So this is a little sketchy. I have, at least in each case. Now, let's say I'm the liquidator of Five-Star Diamond, which is a Nirav Modi case. Everything is seized by this thing, but they are showing huge amount of receivable in their books, would be in all probability from their group companies. But I don't have the data. Where do I get it from? What am I supposed to do?
Agreed, sir. Agreed.
Sadhru sir, and
Debtors are not
perhaps,
like wine that they will mature with time and in value.
Sadhru sir,
तो
and
इसमें
as you
करना
rightly
क्या है?
pointed out,
हाँ.
this perhaps this would be as the valuer is required to make a presentation in the COC meeting. Yeah.
Yes,
So
yes.
this disclosure would be there, then COC is aware this data is not there. Then, as you rightly pointed out, it will be a blame game, because valuer will say that this information RP has not given. RP say that I don't have it. Then COC asking what you are doing. Yeah. So it will bring this kind of a things. But as of now, IBBI would like to have that kind of transparency in the process. So
I think such debtors can be considered outrightly zero, because it is so aged and it may not be possible to recover even a single.
Yeah. So
Because banks also, they don't consider for drawing power if it is exceeding more than 6 months or whatever it is taken for working capital assessment.
Sometimes it is like 4 years old. The company is shut down for 4 years, and then I have seen they expect the RP to go after the debtors who are probably not existing.
Mostly, yes. The COC will always tell that you have debtors of crores of rupees to raise money from there, and I'm not giving you an interim funding. It reaches even that point many a times.
Yes.
लॉजिकली ऑल दोज 4 years से इसने ये नहीं किया, फाइल नहीं किया कुछ, ओके, तो वो तो टाइम बार्ड हो गया ना, वेर इज द एक्नॉलेजमेंट ऑफ डेट, तो कैन इट नॉट बी ऑटोमेटिकली सेट टू बी जीरो? This is something which you people will have to put up as valuers.
Sir, the thing is that if they put zero, then in that case, CD
Sir,
might say that
that
there
has
is
to be
no
substantiated properly.
then COC,
Considering
of course, the value iteration is there, so
let,
you say
let
that
us
let
say,
us make
sir,
some effort to recover this money.
let us say last 4 years, say many a cases, the CD has filed its last ROC returns and everything 4 years back. Okay. अब बैलेंस शीट में तो दिख रहा है 100 crore का रिकवरेबल, लेट अस से 4 साल पहले उसने बैलेंस शीट फाइल किया है, लिमिटेशन तो 3 साल का है, तो वो जीरो तो ऑटोमेटिकली हो जाना चाहिए ना.
Sir, that point, and I think Udayji, we can take it with the IBBI.
We should do that. I think yes.
I think the value should mention the same fact in the valuation report and make it zero.
आज मेरे पास एक केस है, 8 साल से उसने कोई ये फाइल नहीं किया, 8 years, राइट. अब वो केस अभी आ गई, अब उसका मैं सन्ड्री रिकवर डेटर्स के कहाँ क्या रिकवर करते बैठूं यार, 8 साल हो गए. Last 2017 18, yeah, no, before that only they have stopped filing their ROC returns. So what is the sanctity?
Agreed, sir, agreed. That is a very critical point in SFA. Sundry debtors,
उधर ही तो प्रॉब्लम आ रहा है ना आजकल. मेरे से फिजिकल एसेट
Yes.
तो कोई प्रॉब्लम नहीं है, उसका तो
Right.
कंडीशन दिखता है, बट एसएफए ये सब में तो
Even
सबसे बड़ा प्रॉब्लम आ रहा है.
Even on the liability side also, there will be so many fictitious creditors also.
Yes,
One more
creditors.
aspect is that this
And
related party investments,
and
this
those who are
current investments
submitting
or
their claims
non-current
during
investments.
CIRP, they are not submitting during liquidation, means they might have settled in between without the knowledge of the resolution procedure.
That is a possibility. There is always a possibility.
So
Yes,
somebody needs to
then
sit
it
with
will be a
IBBI
puppet
and
transaction,
just
sir.
say.
Yes, then it has to fall under 66 at least.
Yeah.
Because this is a big problem, I feel. As a RP I am facing, SFA में तो बहुत बड़ा problem आता है.
Right. So I think we will have to wind up now. Praveen Bansalji has suggested one thing, that there should be a provision for revision of valuation. So if any further data is secured by RP, so this is a very valid point he is putting up, that if certain more data comes up in 19.2 or whatever ways, we should be able to revisit the valuation. So yes, that is a very important point that has been taken up. So with this, we will go back to Gauri Deshpande for presenting the memento to Mr. Harshad Deshpande, the virtual one, and the physical one will be reaching your office, sir. By courier, we will send it to you in some time. Please go ahead.
Yes.
Yes, so thank you, Mr.
Can
Harshad
you see my
Deshpande.
screen, sir?
Yes, and as the speaker for 22nd of November 25. And thank you very much being presented to you with gratitude by Dr. Ashish Makhija, President at IPNet. Thank you, Mr. Harshad. Thank you for being here and sharing such a wonderful presentation with us. Over to you, Gauri, again.
Yes. Thank you, Harshad sir, and thank you for giving the insights into the valuation paper. Also, we are understanding that nowadays there is a shift from the historical cost valuation to the enterprise valuation, means valuing the underlying assets, the potential assets. And thank you for bringing this today on today's platform. And now I will go to the another topic for today's webinar, that is enhancing safeguards and transparency in CIRP. And this topic is going to be presented by our IPNet West Chairman Udayraj Patwardhan sir. And I would just briefly introduce him, Patwardhan sir. He is in a practice. He is a chartered accountant in practice for more than 2 decades. He is a partner in IPE, Sumedha Management Solutions Private Limited, and he is in this practice area of IBC from the very beginning of this segment from the 2017 and has handled more than 46
That is
cases.
fine. I think, Gauri, we can stop.
Okay, sir, this
We
is
will
all,
start with the
but
presentation.
yes,
So
you may please
generally,
start
yeah,
with
we
your
can save some
presentation.
time here. So we
Yes,
have some
please.
20 minutes. I will try to present the paper before you all with the critical inputs that we will be needing from the members also. So this is the discussion paper for strengthening the safeguard and transparency in CIRP. So they have identified at present 4 key proposals. They are there on the screen. Let us see what they are. One is disclosure of allottees in IM and their treatment in the plan. So this is a very critical aspect that in case of a real estate project, everybody doesn't file a claim. So how to deal such a situation and what is the responsibility of the RP and how it will be treated typically in a resolution plan. So that is the first proposal that is there. Second proposal is disclosure of receivables, joint development agreements, and information on assets which are under attachment in the IM. So what is the responsibility of the RP in disclosing it in the IM about receivables, joint development agreements, and information of other assets or the assets which are under attachment of various enforcement agencies or by other agencies also like sales tax, GST, etc. Third key proposal is safeguard where no financial institution is represented in the COC. So this is something very, very different, and they are trying to what I can say. They are trying to say that when there are financial creditors who are not financial institutions, we will have some more to observe what that COC is doing in the closed doors. So that is what safeguard they want to add. And the fourth one is mandatory recording of reasons by COC for recommending liquidation. So when they are recommending liquidation, why they are doing it, that has to be recorded. So public comments are invited on that. We will go to each proposal one by one. First proposal, disclosure of allottees in IM and their treatment in the plan. So what is the statement of the problem? Let us go to the Puneet Kaur judgment directly in point number 3. What it says is we are of the view that the claim of those home buyers who could not file their claims, but those claims were reflected in the record of the corporate debtor. So people did not file the claim, but they were there in the books, ought to have been included in the IM, and the resolution applicant ought to have taken note of those liabilities and should have appropriately dealt with them in the plan. Non-consideration of such claims, which are reflected from record, leads to inequitable and unfair resolution as is seen in the present case. So Puneet Kaur case has been very critical, and Supreme Court in Amit Nehra and others versus Pawan Garg also has dealt with the similar case. So what is the solution that they have proposed? They have said that A and B, 2 parts, and both are simultaneously to be applied. The IM shall include the details of all allottees, whether they have filed a claim or not, including their name, amount due, units allotted as reflected in the CD's records, irrespective whether those relatives have filed claims, I will add, or not. And the resolution plan shall provide for treatment of such allottees. So they should be given some treatment. The next stage will be whether the treatment will be equitable or not. So that is another question to be answered. We will go to that if at all required. But these are the 2 things which are proposed. And let me tell you, in one of my case, when I was representing them as a counsel, we are now before Supreme Court because the RP has taken a stand that books of accounts do not reflect your claim when I have paid the money by demand draft. I have a consumer court order with me. My claim was belated. He says, I am not accepting your claim because my books don't tell your name. You might be there in the bank records. So there are RPs out there who are denying claims, even if you say I have paid by check also. Given them the details. So if you go to the FAQ of IBBI, you will find that if the records of the CD do not provide the details, the RP is required to depend upon what the claimant has submitted. So that also is existing. And now this proposed solution is inclusion of whatever you know in the information memorandum. So the proposed draft regulation is there, which they have added JA, details of all allottees, including their names, amount due, units allotted, whose claims are reflecting in the books of accounts of the CD, but have not submitted their claims to the resolution professional. So that will have to be added. And after regulation 38, 38A is being added separately. Treatment of allottees not filing claims. So in respect of real estate project, where details of the allottees are reflected in the books of accounts, but allottees have not submitted the claims, the plan shall provide for a treatment of allottees in the resolution plan. It is not saying equitable treatment, but some treatment will have to be given. So that is the first proposal. Let us go to the second one now. Second proposal, disclosure of receivables, JDAs, information on assets under attachment in the IM. So again, I will directly jump to point number 3, wherein Victory Iron Works versus Jitendra Lohia and other was discussed when the court observed the development rights created in favor of the CD constitute property, which the meaning of the expression under 327 of IBC. At the cost of repetition, it must be recapitulated that definition of expression property under 327 includes every description of interest, including present and future or vested contingent interest arising out of or incidental to property. Since the expression asset in common parlance denotes property of any kind, the bundle of rights that the CD has over the property in question will constitute asset within the meaning of 18F of 25(2)A of the IBC. So such incomplete disclosure in the IM, if it is not disclosed, may lead to information asymmetry between the creditors and the respective resolution applicants. As a result, bidders are unable to make fully informed assessments of the CD's assets based potential recoverable value. This is not only undermines the transparency diligence in the process, but also leads to suboptimal and distorted valuations, erosion of reliable value for the stakeholders. So they say that whatever JDA rights you have has to be included. Proposed solution. So what is the solution here? They say that IM should include following: A, B, and C. Details of receivables of the CD, including trade receivables, etc. They must be in the IM. We discussed this point just now, that how to include those things if you don't have the details. But the details have to be included in the IM. And for the IM, you will have to get the data from the management, refer to Regulation 3A and Regulation 4, get the data. If not available, 19.2, and you may end up saying in the IM that I don't have information, I have filed 19.2. Unfortunately, that happens in most of the cases, but it is expected to be included now very specifically. Details of JDA and other similar collaborations that the CD may have, and C, details of assets which are under attachment of enforcement agencies, including particulars of assets attached, authority under which attachment has been made, such as ED, income tax, etc., etc. So though they will have to be included. Now you are aware that IBBI and ED under PMLA have just come out with an understanding wherein the assets can be restituted, that is given back, can be freed from the attachment if a particular undertaking is given by the RP. Even the resolution plan can be shared if the ED gives an acknowledgement knowing that they are aware of the sensitive nature of the resolution plan. So that is what is there, 1, 2, and 3. What is the proposed regulation? 3 have been added in 36(2)A. AA, details of receivables to be added, details of JDA and other collaborations, and details of assets which are under attachment. So these 3 will have to be disclosed now specifically, separately in the IM. So that disclosure will have to be there. And then, of course, the resolution applicant will have to deal with it. Because they are added as assets, resolution applicant will have to have a look at it, that, okay, these are assets which are available. These are my development rights. What amount can I get out of it and all that. In one of my matter, we have been able to protect the JDA and it has gone now to Supreme Court. And Supreme Court has given us a go ahead and and get the resolution plan here heard, and the plan is now reserved last week only. So this JDA matter, we could take it to Supreme Court in one of my matters where they were trying to go get out of the JDA agreement in one of the matters. So this is very critical. We will go to now third proposal. Safeguard where no financial institution is represented in the COC. Now, who is a financial institution? That is defined in section 314 of the code. So typically they are regulated financial entities. So they are discussing the situation where it is a possibility that there is no financial institution, no bank, no ARC, no NBFC in the COC, and only single unregulated financial creditor, maybe one individual or a partnership firm which has given some lending to the company or the LLP, and they hold more than 66% of the voting share, effectively controlling all decisions. So the decisions are controlled by the 66% holder who is an unregulated financial creditor, plus there is no financial institution also. So in such a case, they say that the discipline and rigor in the deliberations in the COC may be limited. So in such a case, they are saying that they are providing a solution here, that where no FI is represented in the COC, so both has to be there simultaneously, a single unregulated financial creditor holds more than 66%, the RP shall invite. The responsibility is on the RP. The 5 largest OCs by admitted claim value, not by the claim made, but by the claim value admitted, to attend the COC meeting as observers. So those 5 will be invited as observers. They shall be entitled to receive notice, agenda, and minutes. So it's not that they will only attend, they will also get the notice, the agenda, and the minutes, and may participate in the deliberations also without voting rights. All decisions taken by such COC shall be recorded with detailed reasons in the minutes. So it is also necessary that the decisions by the COC shall be recorded with detailed reasons in the minutes. So whatever decisions are there, they will be recorded with detailed reasons. Recorded does not mean audio video recorded. Recorded with detailed reasons. So reasons will be recorded properly. So what is the draft resolution? The regulation being proposed is 16E. They are suggesting it as safeguards where no FI is represented, where no FI as defined in 14 subclause of clause 14 of section 3 is a member of the committee, and any other FC holds more than 66% share, the RP shall invite the 5 largest OCs by value of admitted claims to attend the meetings of the committee as observers, and shall record their observations, if any, in the minutes. So their observations will be recorded. The last proposal, mandatory recording of reasons by COC for recommending liquidation. So there are situations where COC recommends liquidation, and it has been observed by IBBI that in some cases the reasons are not recorded because 40D reads COC may record considerations. So that was not mandatory. So what is the proposed solution? To enhance the accountability, it is proposed that in case where compliant resolution plan of value greater than liquidation value has been received, the COC nonetheless recommends liquidation. The reasons for such recommendation must mandatorily be recorded in the minutes and furnished along with the liquidation application. So obviously it will be looked at by the NCLT. So the situation that they are saying is the liquidation value is known to you, the resolution plan is greater than the value of the liquidation value, and still COC nonetheless recommends liquidation. So COC is not expected to, but still recommends liquidation. Then such recommendations, the reasons for the same must be recorded in the minutes and furnished along with the liquidation application. Who furnishes the liquidation application? The RP. So RP will have to furnish it there. So that is what is proposed. Not in every recommendation. If the liquidation value is less than the plan value, then it will have to be told. If the liquidation value is more and the plan is of a lesser value, in that case, liquidation can be recommended without recording reasons also. So that is there. So what is the proposed regulation here? 40D is proposed to be amended as follows. In cases where compliant plan of value more than liquidation value was received, the results for recommendation for liquidation of CD shall be recorded and submitted in the application for liquidation filed by the RP before the A. So that is how it is. And we come to the end of this discussion paper. We are open for discussions now. I have 2 comments here. Let us look at it. So Shantanu Rai says this is a fair proposal, and second one is in case the OC creditors file largest one should be given voting rights. So he is even suggesting that they should be also given voting rights. So
Yeah,
that is one recommendation that we have received here from Mr.
will
Shantanu.
actually
You may try
prevent,
to elaborate this, sir.
yeah, this will basically prevent gaming of the system by promoters by filing application through some entity which may not be directly related to them, but some entity which would be closely working in tandem with them. Okay, so this needs to be in such a case. I must also say they should include ARCs. If there is only one ARC who is the sole COC member, then probably it will be in fairness of things to allow some voting to the operational creditors too. Because this is from hard experience as a IP. Sometimes ARCs only work for their principals who are behind the scene. Well, some of the investors. And the investor could be promoter through backdoor. So ये इसको करने के लिए I feel इस समय में I have seen a case where the OC filed a case. One ARC was 98% holder, and the whole thing got gamed. Whole thing got gamed. So उसमें ठीक है. That landed up into liquidation and things like that. But the OCs got nothing. They were the largest creditors in terms of not singly, but many of them put together. They had a lot of credit to this company, but there was only one FC. So थोड़ा सा IBPN needs to think about this.
Yes. So we can add that. I think FIs can be even further bifurcated into banks and other institutions and all that, because everybody has a different view to look at things, and some are very quick to resolve, some are guided by their investors, and some want a quick resolution, some want every to be bundled, including the promoters. Some want it to share with unsecured creditors, some do not want to share with anybody at all. So those are issues out there. Anybody to add views here? Mr. GKV Rao, please go ahead, sir. You were saying something, Mr. Rao?
Sir, you're mute.
I'm just, supporting Santanu sir's proposal, and to consider debt of OCs above certain threshold limit in terms of percentage of financial creditors total debt.
Yes.
Instead of top 5.
Only of top 5, but there has to be some, yeah, okay. Some threshold also. So we will propose that also. So if anybody has any other suggestions here, they are welcome to type it out or speak out. Otherwise, we have come to the end of our discussion. The last paper that we discussed appear to have been mostly acceptable to many. I can see such comments there that the proposals appear to be fair and trying to address the issue. Yes. So how much we will be able to address that, the time will tell. So thank you very much for everybody being here. Over to Gauri for the conclusion, please.
Thank you, sir. Thank you for your insightful discussion on this topic. And I now invite Varshita to give a formal vote of thanks. Varshita?
Yes. Thank you, Gauri. I am privileged to extend the vote of thanks today. I would like to express my sincere gratitude to IPNet for providing me with this opportunity. Today's event was much more than a webinar. It felt like a start of something truly significant, a movement that will shape our professional community in the years ahead. First and foremost, I extend my heartfelt thanks to our speakers, Mr. Jalesh Grover, Mr. Harshad Deshpande, and Mr. Udairaj Patwardhan. Your presence has added immense value to this occasion. Thank you for gracing us with your time and wisdom. I would also like to thank our president, Mr. Ashish Makhija. Ashish sir, your relentless dedication and visionary leadership continue to make IPNet a platform of unparalleled importance. Your address today reaffirmed that we are on the right path under your stewardship. I would also like to extend my sincere appreciation to transition and technical support teams. You work tirelessly behind the scenes, ensuring that everything runs smoothly. Your hard work is the foundation of successful events like this one. Thank you for your unwavering support and flawless execution. Finally, to everyone who participated today, your presence, enthusiasm, and active engagement have made this event truly remarkable. Together, we are building a community that will not only foster professional growth, but also drive innovation and collaboration in the insolvency profession.